Did you know you can trade contracts for difference, CFDs, and profit on price moves without ever owning the asset? Sounds tempting, but most beginners lose money using them.
Welcome back, traders. Today, we're learning about contracts for difference, often called CFDs. These are financial contracts that let traders profit from price movements without actually owning the underlying asset. In this lesson, you'll learn what CFDs are, how they work, and why they carry both potential rewards and serious risks. By the end, you'll understand why CFDs can be tempting and why most beginners should approach them with extreme caution.
Before we dive in, just a quick tip. If you're watching on a tiny screen, switch to a tablet or a bigger monitor so you don't miss the important details in today's lesson. And if terms like pullbacks or market cycles still feel fuzzy, or if you're not practicing on a simulator yet, pause here and grab your Beginner Trader's Quick Start Guide at www.mmufreeguide.com. It's packed with the key terms, candlestick patterns, and tools you'll need to build real confidence. You've come this far? Don't skip the foundation. You've got this.
Meet Alex. He's been watching stock prices move up and down, and he wants to profit from those price changes. But here's the thing. Alex doesn't want to buy actual shares. He's looking for a faster, simpler way to trade without owning the asset itself. Instead, Alex uses something called a contract for difference, or CFD. It's a financial tool that lets him speculate on price movements without ever owning the asset itself. Alex now trades using contracts for difference. Just like in traditional markets, he can go long to profit from rising prices or short to profit from falling prices. CFDs also give him access to leverage, allowing him to control larger positions with less capital. Quick knowledge check. If prices rise, Alex goes short to profit from the increase. True or false? Lock in your answer. The correct answer is false. If prices rise, Alex goes long to profit from the increase. He only goes short when he expects prices to fall. CFDs aren't limited to just one market. Traders can use them to speculate on Forex, commodities, indices, cryptocurrencies, and even stocks of major companies. CFDs are commonly offered by Forex brokers around the world, but they're not permitted for retail traders in the United States. U.S. regulations ban brokers from offering CFDs to U.S. residents. Unlike traditional investing, where most beginners only buy and hope prices rise, CFDs let traders easily profit in both bullish and bearish markets. They can go long or short with a single click, without the extra steps or restrictions of short selling. Knowledge check. Alex expects ABC shares to rise from $50 to $60. He goes long with a CFD at $50. The price soon reaches $60. How much does Alex earn if the price of his CFD rises from $50 to $60? You got this. The correct answer is $10. Alex went long at $50 and the price rose to $60. He earns the difference between the entry and exit price, $60 minus $50, which equals $10 profit. To sum up, a contract for difference is a financial contract where traders speculate on price changes without buying the actual asset. Instead, they agree to exchange the difference in price from the time they open a trade to the time they close it. Question: true or false? A contract for difference allows traders to speculate on price movements without owning the actual asset. Lock in your answer. The correct answer is true. CFDs let traders speculate on price movements without owning the asset. Instead, they profit or lose based on the difference between their buying and selling price. As with any market, trading CFDs can be profitable, but traders must understand the risks. CFDs use leverage, which means you can trade with more money than you put in. This can lead to bigger profits, but also bigger losses, sometimes more than you originally invested. Here's how leverage can work against you. Alex uses 10-to-1 leverage to open a $1,000 CFD position, putting up just $100 of his own money. If the price drops from $50 to $40, that's a 20% decline. He loses $200 on the full position. Because he only invested $100, he not only loses it all, he actually owes another $100. That's how leverage can make you lose more than you put in. But leverage isn't the only thing to watch out for. When markets get volatile and prices move fast, spreads can widen, meaning the gap between the buying and selling price gets larger. This makes it more expensive to open or close a trade. You can also face slippage, where your trade executes at a different price than you expected, and commissions or fees can eat into profits. Even if the market moves in your favor, these costs can affect your results. Here's why some traders use contracts for difference. They can profit from rising or falling prices, trade with leverage to control more with less, access many markets from one account, and they can do it without owning the actual asset. Question: true or false? CFDs always guarantee profits with no risk of losing money or losing more than your investment? Lock in your answer. The correct answer is false. CFDs carry significant risk. They can amplify both gains and losses, and you can lose more than your initial investment. There are no guaranteed profits in trading, so always manage your risk carefully. Before we wrap up, remember this: CFDs are powerful tools, but they come with significant risk. Because they use leverage, they can amplify your profits and your losses. In fact, you could lose more than you initially invested. That's why managing your risk isn't optional. It's essential. Well done, traders. You've added contracts for difference, or CFDs, to your trading knowledge, an instrument that lets you potentially profit from both rising and falling markets without ever owning the asset. Now you understand the key financial markets and what can be traded in each. Use this knowledge wisely and keep learning, keep practicing, and keep sharpening your skills.
Great work today. Don't stop here. Subscribe to Market Mindset University and download your free Quick Start Guide to build a solid trading foundation. Our journey's just getting started.